just moving on really to, I think, a broader point that we all have to grapple with at the moment. I mean, and that's going to be how inflation impacts people's investment decisions. I mean, I'll open this up to anyone who wants to answer, but I mean, if inflation is now the overriding concern for most investors, is there a response that they can make to it? Does it really matter? And what sort of quirks does it throw up in terms of the companies you look at? I'll open it up to anyone who wants to answer that.
Maybe I'll go first. I mean, clearly inflation matters. The cost of living crisis that we experience in the UK and similarly in the US and in the EU and Europe overall is felt by consumers. Now, on the positive side, there's a lot of excess savings that many households have coming out of the pandemic, and that buffers some of that increased cost for energy and food. But especially when it comes to lower income households, they already have to start cutting back in some of their consumption decisions. And that is certainly going to be a drag on consumption growth going forward, and with that on economic growth. But there are also effects, of course, on the investment side. If you are faced with substantial inflation as a business, well, you have to find ways around that kind of cost pressure. And that's easier for companies that are asset light, and that have certain pricing power and or certain ways of generating higher revenues that compensate for the increase in inflation.
Okay, that's an interesting point. I mean, Simon, from a stock picking angle, how would you factor that into your calculations when you're looking at companies? Is there a methodology that you have to change, or are there things that are affected in your decisions?
Well, that last point is very, very key, actually, is pricing power. Can companies pass through pricing to the consumers? And ultimately, most certainly most big British companies have been around a long time. They do have some sort of pricing power, or they wouldn't have survived. But there can be a time lag. So you may see short term some pressure on that earnings, and then they get it through later. There's also other considerations, though. Clearly, as prices go up, it hits the demand. Demand could be offset or upset, because prices are too high, and that could see lower spending on the products. But there's other considerations like assets companies have got. So if you buy a company with assets that might grow over time with inflation, so a house builder has a lot of land typically, it's a property company, will have real assets which go up in value, that gives you some protection of it against inflation. If you have companies that can raise their prices on some sort of regulatory formula linked to inflation, that can be helpful for some of the utilities. So you have to look almost company by company, but certainly industry by industry, at the different impacts of inflation, and think not just about the immediate impact, but what does ultimately have that do to long-term demand? And then also the biggest risk is probably not inflation itself, but unemployment. And as long as people are still in work and actually wages are growing quite fast, then the economy is probably okay from a nominal point of view. We may have a technical recession the economy might grow slightly lower than a high rate of inflation. But if people start to lose their jobs and companies cut back significantly, then I think we are in a more difficult scenario, and that's where you would see a bigger impact on end demand, and more uncertainty. So it's there's a lot to that question. There's a lot to think about, but the company level, it's unfortunately it's very detailed analysis you need to do and think about individual businesses and industries.
Because it can affect how you view certain metrics. Because if you're looking at things like return on capital, inflation can completely mess up your view of that. I mean, what sort of pitfalls can people avoid, or what sort of things can you sort of get caught in that?
Well, historically, the equity market tends to like the rate of inflation to between about 2 and 4%. Below 2% is a sign of a really sluggish and low growth economy. Above 4, you start to have the type of problems you talked about, where when you're replacing your equipment and your capital spend, it's costing you more. So the business is absorbing more cash in order to just keep funding itself. If you have inventory, stock, that absorbs more cash as well as you grow, or even if you're even a static business with inflation. So cash generation of companies tends to drop as inflation goes up, which is another reason why you might pay a lower valuation for those earnings, because they are generating less cash, and also the discount rate goes up, so investors demand a higher return when inflation's higher, and again that pushes you to a lower valuation of shares. So it's there are those two measures, the discount rate and the return on capital, as you talked about, I think that can both be impacted with higher rates of inflation.
Okay. And Eloise, just to turn to you for a minute, what about, you have experience with technology companies which are typically inventory light. I mean, they don't tend to have anything that sits on the books for very long. Is there an impact that inflation has on those kind of companies? And I mean, how would you define that?
Yeah, definitely. They're probably one of the ones that are most hardest hit during inflation. As the purchasing power reduces, we also see an increase in the cost of borrowing, which a lot of the kind of startups and early growth tech companies tend to rely on. But the investors are essentially banking largely on future income streams. So what we have seen with these uncertain times during the current market conditions is that investors typically lean more towards equities that provide near-term earning certainty, and they've really been shunning these growth-orientated sectors, which technology very clearly falls into.